I want to look at some of the Lemonade bear arguments or potential risks for Lemonade, and that are very commonly said, and then give my take on each one of them. So the first bear take or risk for Lemonade says, hey, they're going to grow too fast, aggressively growing. They're not going to turn any profit, or certainly no meaningful profit. And then their surplus requirements are going to continue to grow as they grow their top line, their book of business, but they can't keep up with it with their own capital. That will shrink, and they'll need to do a capital raise in the next few years. The key assumption in this bear take for me is that they will not be turning a profit. They're not going to be turning any profit, and they don't make any profit. So because you're making no profit at all, then if you're not making any profit, you're not going to have a successful business. That's very obvious fact. And for an insurance company, it's even more complicated, because if you continue to grow your top line and you're not making any profit, well, your top line, you have surplus requirements, amount of money you have to set aside to pay potential claims, say there is a big catastrophe. But the error in that assumption, at least in my mind, is that I think, Lemonade is going to turn a profit. We're already cash flow positive. Next year, we're going to be strongly believe we're going to be adjusted EBITDA profitable. And then the year after, 2027, net income profitable. So I think this core assumption that they're not going to turn a profit is just a wrong assumption. And I did a video previously on this exact topic, which I'll link above and down below. And in that video, as you'll see, there's a real simple spreadsheet I made, which is linked in that video description. And I'll also link that spreadsheet down below here. But in that video, I show, even if they say they're growing their top line 30%, even if they start making a modest underwriting profit, say 5% profit, then they'll be fine. Then they'll be able to maintain and grow their surplus even in the midst of growing their top line aggressively. And obviously, we hope to see them grow and have more and more operating leverage so they can have even better than 5% returns.
So the next bear take is that operating leverage we've seen is only because they overhired and overbuilt capacity. Operating leverage won't continue as they scale. And I actually think this is an underrated bear take or criticism or possible criticism of Lemonade and us as a Lemonade community, that I'm surprised actually the Lemonade bears don't harp on this or articulate this more. But essentially, we as Lemonade, as management and Lemonade shareholders and people that are bullish on the company, we often show, or point to this graph that shows, hey, look, top line IFP has been growing, all the while. All of their other operating expenses, other than what they're spending on growth spend, but all the other operating expenses combined have been completely flat. It really is a phenomenal graph from the bull's perspective that shows, hey, look, top line keeps growing, keeps accelerating and moving forward up and to the right. And all these other costs that, aside from what you're spending on growth spend to grow the actual book of business, everything else is fixed. So you're getting this tremendous operating leverage, and you could see this operating leverage continue further out into the future. But the bear argument here would say, hey, this graph doesn't really tell us anything. All this graph really means is that they overbuilt, overhired, and overspent on their capacity and their structures for capacity well before they needed to, and in the end are wasting money. And that's why, hey, they're not profitable until at some point they're going to hit this wall, and then they're going to have to keep spending, and the non-growth spend operating expenses will continue to grow. That would be the bear argument that says, hey, it doesn't really tell us anything. All this means is they spent too much money in the past building out systems, hiring people, and that was foolish of them, and they'll just have to catch up and then hit a wall. But my own bullish response to this criticism or this bear take is that I believe they will see the operating leverage continue that is displayed in that graph. Why do I think they'll see that operating leverage continue? Because they showed us the nitty-gritty, some of the details, especially at Investor Day, Adina's presentation, where she showed how integrated their AI was in their complete system in terms of customer service or claims handling. They showed us some of the behind the scene details of how, hey, they're automating a massive amount of what the upfront sales of their policies, like something like 97%, and then they're already automating a massive amount of their claims. And both of those will only improve in the systems they have, and even the amount of claims that will be fully automated, I believe, will only go higher and higher, as well as, other customer for service requests. They'll continue to become fully automated and get better and better. And if you can make something fully automated and it even delights customers more than, say, even a sort of more manual human-driven system would, then it's inevitable that you're going to build this quote-unquote autonomous organization, and you will experience and have this incredible operating leverage. As part of Adina's presentation at Investor Day, she showed this graph that showed, hey, Lemonade's at, about, right now it's about $800,000 of IFP per customer, and then other, insurers are not per customer, but per employee, about $800,000 of IFP per employee. Other insurers are at around maybe $1 million of IFP per employee, but as Lemonade grows, they expect by the time Lemonade gets to 10 billion of IFP, they will have something, they believe they'll be able to get to about $4 million of IFP per employee. This roughly means they would double their employee count from about 1,250 to about 2,500 employees, while they 10x their premiums from about $1 billion of IFP to 10 billion of IFP. So Lemonade, in my mind, it's very, very clear the systems they're building are going to allow them to have massive, massive operating leverage. And this bear take that says, hey, they just overbuilt and they'll never, they're going to hit a wall at some point, I think will be disproven over time. The third bear criticism or risk for Lemonade we want to discuss is that they say that car will not become an excellent product with lower loss ratios. They just say, yeah, car's loss ratios are too high. They're never going to be lower. End of story. I actually find a lot of bear arguments are kind of like this. They're extremely surface level. They say things like, hey, Lemonade, yeah, they lose money right now, so that's it. I'm not going to invest. They're a bad investment because they lose money. That's literally as deep as the analysis goes. And this car criticism, is about as deep as that gets. It says, hey, meaning it's extremely shallow. It just says, hey, car has poor loss ratios. They're not going to figure out car. End of story. They're a bunch of losers. It's essentially, it has nothing fundamental in the argument at all. It just comes down, it's almost name calling, just resorting to a level of name calling. Says, hey, these guys are dummies and losers and they'll never figure out car. End of story. And they can't transition into car, so car's not going to happen. But as you notice, there's no fundamental analysis. There's no deeper analysis in this kind of thought process. There's definitely no first principles thinking in this type of thought process. In my mind, it's obvious for them, sure, their car loss ratios are still a bit too high. They were worse and they've become significantly better. They're still not where they need to be or want them to be, as their end goal, but they are, on my mind, on track to get there. They did inherit or get a Metro Mile book of business that was really not a great book of business. They have regulators that are very slow to approve price changes. It also takes time for them to just test and figure out and get feedback loops on all their data and all their customers. Like other sort of problems, like say you were designing an AI that, identifies a cat or a dog, a picture of a cat or a picture of a dog. If you know the answer to the cat or the dog problem, you can have that feedback loop completed very, very quickly. You can say, hey, I'm going to test. Do you think this is a cat or a dog? And the computer will tell you whether it's cat or dog or the AI. And if you're right or wrong, you can quickly tell it, hey, you're right or you're wrong, and then you can improve and have feedback. But for Lemonade, you're pricing someone's risk and maybe driving scores on a whole multitude of variables and situations and where they drive, how they drive, et cetera, and what kind of risk profile that could look like. It takes some time because they don't know the answer right away, whether this person's a cat or a dog or a good driver or a bad driver. It takes time for all those variables, all those details to flesh out and then start to see, hey, these are the signals that are important, these are less important, et cetera, et cetera. And then, so that's a feedback loop that takes time. And then as well, on top of that, then even once they know the answers they want or the changes they want to make, then they have the feedback loop of regulators. So the whole process of insurance takes time. And I've said this before in other videos, if Lemonade gets ahead and wins in the space, this will actually flip and become a moat for Lemonade, because other insurtechs that want to follow in their footsteps are going to have the same challenges they have and have the same sort of difficulty and problems that Lemonade has, except in that future scenario, Lemonade right now is competing mostly against other legacy insurers that aren't as sophisticated with their data or their telematics, while an insurtech in the future, say some other startup company will have to be competing against the likes of like a Root or a Lemonade that's in the market and is really driven. All of their data is driven by telematics and really data driven decisions. And ultimately, my first principles thinking on their car product is that, of course, their car product is going to get better over time. If you can continuously monitor the accelerations and movements of someone's phone in their pocket or in their car as they drive, and you see how quickly they swerve this way or that way, or they brake, or they speed up, or they drive it recklessly at 3 a.m, or they go to a bar and then they drive home fast. All those sort of scenarios, they can tell you some really critical data signals that could weed out the really reckless and most dangerous drivers from the very conscientious, courteous, careful drivers. Like, it's very obvious where that should head. Eventually you should be able to have a world-class product that offers the best prices to the best drivers and the worst prices to the worst drivers and discourages them, so you avoid them altogether in your book of business. In my mind, it's only a matter of time. Like, it's going to be one of those things that people will say, oh, in hindsight, that was obvious. Yeah, of course, if you measure telematics and you carefully, continuously monitor drivers and exactly what they're doing at all times, yeah, of course, it makes sense. You can actually price them a lot more accurately. Like, it makes complete sense. It's only people I find have so little vision of the future. They see a tiny little bubble in front of them. The average person, the average kind of individual, that they can't understand or fathom. They can't sort of extrapolate even like a couple steps into the future, even though it's going to be so obvious. And in hindsight, those same people will say, wow, yeah, in hindsight, it was actually obvious that this was going to be a big deal, if they even thought about it. So in my mind, I'm not worried about the car product. I think the car product is going to be a massive success and be one of the best car products in the whole market in terms of its underwriting capacity, in terms of its UI and user friendliness. So I'm not worried about their car at all. I just see huge upside in the car product. The next Lemonade bear take is they say full self-driving will ramp aggressively in the market and the car product will be cut short, be much less meaningful than we hope it could be. I mean, I think this is one of the more valid criticisms because, myself, I'm a big Tesla bull, Tesla shareholder. I've been a big Tesla fan for a long, long time. I do think they're going to solve full self-driving. We're going to have robo-taxis in the future. It's going to be incredible for transportation, cost of transportation. But in my own mind, there's a couple sort of pushbacks I have, here's my own thoughts on this risk. For one thing, scaling a huge car fleet, deploying that car fleet through the world, adopting, having people believe in, accept full self-driving, sell their own vehicles, no longer use their own vehicles, started relying on using full self-driving. I think that's going to take a significant amount of time just because there's, whatever it is, a couple billion vehicles in the world or whatever the number is. There's a whole pile of vehicles in the world, and it takes time for people for the manufacturing of the robo-taxis, the regulation to be accepted, and even sort of public perception and acceptance and adoption of the technology. I think it's going to take a significant amount of time for that to really roll out significantly. So for one, there is opportunity in the meantime, and again, it's just going to take a significant amount of time for it to roll out. And then even as it does roll out, it's not clear whether there's all drivers in all situations are going to be full self-driving, all robo-taxis, or a certain percentage of drivers and certain percentage of the market that still is going to be people driving themselves, or maybe just owning the car themselves, and maybe they have car seats and there's certain setup that they really require and need, and certain things in the car they're in and out that they want, and so they don't use it as a robo-taxi and they drive it themselves only, and then they still have their own insurance. I think there's still going to be a certain slice of the car, population and the driving that occurs that is still going to be done that way and require, like a typical sort of insurance policy like you would sell now. Now, of course, in that scenario, the car insurance market is going to shrink, but also the car insurance market is a massive, massive market. If we believe what I just said, that their car product, continuous telematics are going to result in a much better underwritten car product, they could still take a significant slice of that car product. And right now their car product, in the grand scheme of things, is essentially zero. So they could still grow from zero or near zero to a much higher number, even in that scenario. And then I also believe, say, for the other part of the population of cars that are, say, maybe they're all Teslas that are full self-driving or full self-driving driven, I believe some of these Teslas will be owned, say, by Tesla and operated by Tesla, and maybe they would buy insurance from other insurance providers. Maybe they would have no insurance from others and have their own enough money themselves set aside that they could essentially cover any costs associated with any damages that occurred. But there's still going to be, whether it's even owned by Tesla or even individuals who own their Teslas or their their robo-taxis and hire them out, I still believe there will still be a segment of insurance that covers just other damages to the vehicle. Say it hails, or there's a fire that burns the vehicle down, or an animal runs into the vehicle and damages it, or it's vandalized in some way, or there's a flood or a hurricane and it's damaged. Like there's still a portion of insurance that is still going to be applicable there and still could be sold, and it still be a significant market even for the robo-taxis. And I also think for companies like Tesla, some Tesla bulls think, hey, Tesla is just going to own all the robo-taxis and push all the robo-taxis out because they'll take the most sort of value of the value stream and make the most dollars and profits. Well, in my own opinion for Tesla, I think it's a better strategy to almost push adoption by individuals in the marketplace who can say, hey, I'm a local owner operator of these, I own 100 Teslas and we clean them every night and they drive around all day and that's my business. I think in some ways that is a better business model for Tesla than Tesla trying to operate all of those cars themselves, because I think if people flip it the other way, say, let Tesla just own all the cars themselves, I think they are underestimating the sort of challenges and details and, flat tires that happen and dirty cars and something that goes wrong or damage and rocks in the windshield and the little details that need to be fixed. Those sort of things that happen when you're operating a business, sort of nuts and bolts business like that on the ground and helping, directly to the customer. So in my mind, it's better for Tesla to focus on making those vehicles as fast as they can, rolling out adoption and selling those vehicles, assisting people in their own operations of those fleets. But I think it makes more sense that there's more of the robotaxis are going to be owned by individuals and companies that will operate them. But the point of all this and how this ties back into insurance is that I think there's still going to be probably more need for car insurance in that case, because you have individuals that still say, hey, I want to protect my vehicle and my assets, and say I own 100 cars and they drive around all day. Well, I'm going to have insurance for all 100 of those cars. And maybe it's not the same kind of insurance that protects against an accident, because maybe Tesla's liable for that if the car is driving itself, but there's all these other causes for damage that could happen to the vehicle, and they'll say you get a rock in your windshield or whatever it is, or flat tires or vandalism or environmental disasters, and then all those kind of scenarios. I still, there's still going to be insurance there that Lemonade could be part of that market. To sum up the full self-driving, I still think, it's going to take time for full self-driving to expand into the market. It's not clear to me whether full self-driving will take the entire market as a whole, or maybe just part of the market. Maybe it's going to take half the market, 60% of the market, whatever it is. There's still going to be a remainder of the market that's probably more typical to how cars are driven now, and still have a huge chunk of insurance needs there that Lemonade will be able to grow from near zero insurance into that insurance. And then even on the full self-driving side, you're going to have probably more owner-operators, sort of fleets of cars, and those owner-operators are going to still have some types of insurance for their vehicles. It just might not be as much dollars, might not be as expensive as insurance is now, but it's still going to be a massive, significant market in my mind as a whole when you think about that whole picture. So the final bear argument I want to talk about is they say AI is just going to get so good that, or legacy insurers will just be able to partner with companies like Palantir and close the gap on any advantage Lemonade has. So they'll say either they'll partner with a company like Palantir and they'll completely catch up, or AI will just get so good you can just, anyone, anywhere, any company will be able to just plug into that AI and completely transform their organization and do whatever they want, make dramatic, powerful changes, and completely catch up and even surpass Lemonade. My rebuttal against this, or my take on this one, is that I think culture is the most critical thing to true change. Ultimately, your belief systems individually and your belief systems collectively as an organization, and your vision of how you sort of see yourself navigating into the future is the most critical thing that either allows for true change or restricts true change. So while I do believe, hey, maybe legacy insurance companies can become more efficient and faster and more automated in some of their processes, I don't think it's still going to have the sort of complete cohesion and depth that, say, Lemonade is building and does have and will be able to have. And I think for legacy, ultimately, it's their own internal conflicting cultures and organizations that don't really work well or aren't really made to build that kind of seamless organization, because they don't have the experience, for one, or the people, their expertise to make that kind of a system, but also they have very heavy internal conflicting interests. So you have people inside of a legacy company, the more people that maybe, if you became more efficient, or your customer service experience, became more and more efficient, it could be large teams of people that might be out of work. Well, suddenly, it's not so popular, those policies, and you're not so motivated as a company or an organization to really be pushing heavily into those areas of change. You might have management and executives that know very little about transforming an organization or building this sort of seamless digital AI inhabited structure. And why would these executives then want to sort of push and pioneer into that? Because even from themselves in their leadership roles could be really, honestly, if they were really, doing the right thing, maybe they would be stepping down and having somebody else lead. But of course, that's a strong conflicting interest in their own minds, because they don't want to do that. They don't want to give up their position or where they work to get to. So they would rather, in their, whether they think about it or not, I think in those situations they would rather just sail the ship as long as they can until it sinks. So ultimately, I think culture is going to put a major constraint. I think maybe these insurance companies can partner with Palantir. Maybe they can become more efficient, more effective. But ultimately, their own cultures, even their own investment structure, they'd have very conservative investors that would be very worried about drastic changes. All of that is going to limit or stop any sort of really, really drastic, intense change. And one of Lemonade's co-founders, Shai, wrote this excellent thread on how they're using AI at Lemonade. And what the number one on the thread was, he talked all about culture, how culture is the number one reason for successful organizational change. If you have A strong culture, people that think elastically, are nimble and ready and eager for change and ready to make anything and everything better, then you can have drastic, quick, immediate, lasting change. If you have people that are resistant, slow to change, maybe close to retirement, don't want to learn new systems, change could mean they're going to be out of a job or less important to the organization, then you're going to have people that actively resist change and protect their own space or territory that they have. So those are the most common bear takes on Lemonade that I see. What did I miss? Let me know down below in the comments. Thank you so much for watching. Remember, it's in the bag.